Good morning, everyone. Welcome to this update for global stocks and commodities for the 24th of November. In this edition, I want to just continue with, I think, probably one of the most valuable things that I can provide in this forum, and that's perspective on the market, on what's actually happening, as opposed to what the media would believe, would have you believe is happening. And it's a really important point because I get lots of commentary and comment from members and non-members, pretty constantly. So I've got a good feel for how people are thinking. And there is still a surprisingly high number of people out there that are still really fearful about the market because of what the media is feeding them. And it's just such an unfortunate situation. So that's going to be the main thrust of this week, and I think it's really important. Yes, the American market is overbought. But there are still opportunities. We'll probably get some sort of pullback. In fact, I hope we do, because it had 6 weeks up in a row, and you just need little pullbacks just to sort of clear the overhang. But there's still terrific opportunities, and that's the thing that you should focus on, is the opportunities, not what possibly might go wrong. So importantly in this update, stay with the dominant trend. The dominant trend has been up for a decade, and I don't see any reason why it's going to not continue. Trying to sidestep periodic pullbacks is pretty futile, really, because you don't tend to get out immediately, so therefore you're getting out generally well off the top, and often where your psychology would have you getting out is probably pretty close to the low. So you actually do yourself a disservice, and I don't know too many people that can consistently get in at or re-enter the market at a lower price than what they got out of the market. Generally it's the other way around. So it's a bit of a wasted effort, really. You need to know what is a really strong business, what is likely to go up with a high degree of probability over the next 6, 12, 24 months. Have conviction about it. Get that conviction through one method or another, and stay focused on your game plan, and just forget the rest. Because the reality is, since 2010, so we're closing in on the end of a 10-year decade in the market, the S&P would have risen by 9 out of 10 years and has gone up a total of 200%. So for those that have been worried over the last decade about the next bear market, the next GFC, were misled by the media and were convinced that everything was going to come tumbling down, that's what they've missed out on. That's the factual reality. We'll look at the normal stock and commodity trends, and Portfolio Analyst last week. Again, I think it was a pretty good one. There's very, very positive stories in Australia and a couple in America, and we're exploiting those really nicely. So let's get to the market. The S&P finally had a down week. It was 6 weeks up in a row, and it slipped just a little bit, just 10 points. So that ended the weekly winning streak, and we may get a couple more weeks of mildly down, but it's pretty hard to see anything much beyond that. And I see no reason why the typical end-of-year rally, as the fund managers dress things up, won't occur again. The global economic status is pretty much unchanged. Europe's certainly in difficulty. Japan's not going anywhere. China is stimulating a little bit more, but really nothing much has changed, and the American economy is good enough. So it's been this way pretty much all year. The media is trying to beat up a looming crisis because that's what sells, but the facts don't remotely support the story that the media is feeding you. So just be very, very careful about what you read and what you listen to. The US dollar was pretty volatile. It went down and then managed to end up with a very slight gain back at 98 and a quarter, but spent most of the week lower. And the 10-year yield slipped a bit back down to 1.77. So let's take a look at the price charts, and we'll start with the S&P on a monthly chart. So there's the bottom of the GFC, February 2009, and that's what's happened while a reasonably significant proportion of investors have been worried to death about, when the market was going to fall over again. Those that could see the upside, that had conviction, that did their homework, have profited extremely well. So that's the monthly chart, and you can see it's well above the moving averages that are still lined up very nicely. So there's no change in the dominant long-term trend. That's the fact. And here we are on a daily chart. So the breakout occurred on the 28th of October. So we're now a bit over 3 weeks into that breakout, and you can see there's no large range candles. It's all pretty modest, and there's no reason why this won't continue through into the end of the year. And the other indices pretty much line up as well. There's the US dollar. We had a gap down on Monday, but then managed to recover, and a pretty good session on Friday night. The Aussie dollar, of course, went down, went the other way, and just continues with its long-term downtrend. And if we look at the ASX 200, we are forming up a bit of a wedge, which I guess is possible that it could break out to the upside. From a fundamental point of view, with the banks being such a large contributor to the index, and looking at what could drive the bank share prices higher, I find it incredibly difficult to envisage the ASX 200 breaking out. But look, it really doesn't matter, because I don't. It's just a meaningless index for me. It's something that gets reported on the nightly news, but it actually means nothing to me. I'm very much focused on small cap growth stocks. That's where the story is in Australia for sure. So just to summarise, our dollar down just under 68, and our index lost 1.2% across the week. It's the small cap growth stocks that are highly likely to continue growing strongly, and that growth looks like it's going to be substantial. And look, there's plenty of stocks that fit the bill. I've got a working list, watch list in excess of 50, and a current active list of about 25, where I'm as good as convinced that stocks are going up by a very, very significant margin over the next 1 to 2 years. So that's what investors should focus on, and not some media beat up about what's going to cause the next recession or the next bear market. Now, in a general bear market, that should read, yes, everything's going to go down. I think it'd be stupid to say otherwise. But the best growth stocks, they don't fall very far, and they don't fall for very long. They recover the quickest. So generally all you've got to do is just wait it out for a couple of months, and perhaps cash up a little bit, and then have some attack capital to come back into the market at lower prices. And you might do a little bit of hedging, but look, hedging is always a bit problematic. So look, I think that's just the way to play a bear market. But having said that, I'm not really concerned about that at the moment, because the conditions for a bear market are just not on the horizon that I can see in any form. The only concern that I have, which I mentioned last week, I think the biggest risk to the stock market is the outcome of the US election next year, and that is if the Democrats win and come in with an anti-business, pro-Medicare for all kind of agenda. And that's not making any comment about their agenda. That's just observing the impact that would have on the stock market. And I think that would be potentially quite serious. I think if Elizabeth Warren came in as president at the end of next year, then you could see the US stock market fall 25 or 30%. Such would be the negative impact. But hopefully that won't come to pass, and we'll just have to wait and see. But in the meantime, I think the US market and specific stocks have got considerable upside yet. And the so-called defensive stocks that people tend to go to when they get worried about things just may not do what investors think in terms of limiting your capital downside. There's a lot of the traditionally defensive stocks that I think are at risk of very, very substantial falls in a downturn. Turning to precious metals, gold was down by $6, down to 14.62, and that was really just about the US dollar strength on Friday. Important support is still holding for gold around that 14.50, 14.45 mark, and we do have seasonality in our favour. Seasonality in terms of actual buying, and just general seasonality in terms of price patterns. So that should have some sort of impact between now and February. So this is the window. This is the strongest part of the year for the gold market from November to February. So hopefully that should kick in soon. GDX was flat across the week, so nothing really happening there. And the Australian gold stocks are also lacking momentum at the moment. But we've certainly got some good corporate activity, mergers and acquisitions activity going on in the Australian market at the moment. Okay, let's just quickly check in on the gold price. So there's gold on a weekly chart, which is the most worthwhile to look at. So this is the wave for longer, more complex consolidation that I've talked about now for quite some time. So it's playing out pretty much as I would have expected. But now the seasonality is turning positive. Hopefully we'll see this start to move up again and maintain its position inside this quite steeply rising channel. You know, the media doesn't really reflect on how strongly gold recovered from basically in the last 12 months. So 12 months ago we were trading just under 1,200. Now we're trading at 1460. That's been a pretty steep rise for the gold price. Turning to other commodities, copper was steady around 265, and crude oil managed to finish unchanged, just under $58, but it was a hugely volatile week. All over the place, the crude oil price. There's the spot copper chart, no real change there, and nickel has come off its highs, but ticked up a little bit. And from a long-term perspective, and I don't really have a feel for when this is going to start to have an impact, but from a long-term perspective, there is certainly a couple of nickel stocks in Australia that look really interesting and I think have some significant upside. So to wrap it up, it's absolutely human nature to be fearful of what could go wrong. I mean, that's just how we're wired. So, you know, if that's what you feel, then there's nothing wrong with that because that's perfectly normal. But you really need to take care what you read and who you listen to because most of it will set you on the wrong track. And I can't emphasize that enough. And for those people that have been fearful periodically since 2009 and are ready to jump ship at the slightest hint of something going wrong, they've missed out massively. And for what? Because they listen to a bunch of people in the media or a bunch of other people that are trying to sell you something that have got an agenda. I mean, that's just the long and the short of it. So just be very, very careful about who you listen to. The biggest risk for markets, as I said earlier, is the US election result. I guess if inflation kicked up and interest rates had to be raised, that would also be a very significant negative for the market. But at the moment, the probability of that happening, of interest rates having to go up significantly, looks pretty remote. So I'm really discounting that as not an issue at the moment. So for me, that's the biggest risk right there. Portfolio Analyst this week, I'm going to be providing an update on a couple of the 10-bagger potential stocks that are just barreling along absolutely beautifully. And I couldn't be happier with the way that portfolio is coming together. That's it for this week. There's my contact details for non-members, and I'll be back with you next week. Cheers.